Hello everyone. Today we are discussing one of the very serious crises which have hit Indian mutual fund industry and which has hit our debt fund, Franklin Templeton debt fund crisis which have happened. We'll look back what has happened, what transpired this crisis, because on 23rd April this news flashed everywhere that Franklin Templeton, which is a very prominent name in the mutual fund industry across the globe and also in India, suddenly decided to close their six very prominent funds. They were old funds. They were running from last 10 years, some of them, and they've suddenly decided to close them. And the reason which they have cited off is that there's a huge liquidity problem and there are huge redemption pressures are coming on their way, and therefore they have no option but to close these funds. Now, it's an interesting peculiar condition because this has never happened before, and let's see what are the reason which prompted uh, for a fund house, a very prominent fund house, to take this drastic action. For that, we'll discuss in this short video how actually a bond fund work or debt fund works, what risks do they carry, and how all this transpired for Franklin Templeton to take this drastic action. Is COVID-19, which is a very unprecedented crisis going at present, is the only reason for this, or there has been some story which was building over a period of time? Right. So for that, uh, we need to understand how the mutual fund scheme actually operates. Now, mutual fund, as we all know, uh, is uh, is a is a scheme of operations where the investor pool their money, give it to the fund manager. Fund manager, uh, on the contrary, invest in the securities, and thereafter securities which itself generate returns, and returns are then passed to the investors. Now, in case it's a debt fund or it has exposure of debt fund, the fund manager invests this money in securities which comprises of bonds or debt instruments. And why do I invest the money in the bond and debt instrument? Because typically a bond will generate some interest, and this interest will be an income which the fund manager will earn, and that interest in the form of return which will be passed to the investors. Besides that, these bonds or these debentures will be traded, and depending upon how the price of the bonds or the debentures will be, and that returns will also be passed back to the investors. So uh, now, there's a conception in the market that debt funds tend to be very safe, and you tend ask the advisor generally ask people who are highly risk averse to, if they're highly not ready to invest in equity, you tend to push people to invest in debt funds. But is debt fund or are debt funds really safe? Now, let's look at this aspect also, whether the debt funds are all safe in this or not. So the risk which the debt funds carry. Now, what are the different types of risk that debt funds? So it's the first thing, debt funds are not 100% safe. There's not assuring you 100% principal guarantee. So they do carry a risk. So one prominent risk which they are carrying includes the interest rate risk, credit risk, and liquidity risk. So it is not a totally a risk-free investment. Now, let's look in detail what really these risks are. The first and the most important risk, most pertinent risk in the debt fund is the interest rate risk. Now, what is the interest rate risk? Interest rate risk is if in the economy the interest rate changes, the bond prices tend to change. Now, what is the relationship the interest rates and bond prices have? So, if typically an interest rates in the economy rises, the bond prices will fall, and if the bond prices fall, the yield of the bonds will go up. On the contrary, if the interest rates in economy falls, the bond prices rises, and because the bond prices rises, the yield of those bond also fall. Now, how does it work? Now, there can be a mathematical explanation for this, but one can look intuitively. For example, typically, what a plain vanilla bond will look like. A plain vanilla bond, when it will look like, it will have a face value. Let's assume rupees 1,000. It has it has a tenure. Let's assume the tenure is 10% interest. It has uh, 10% interest is the rate of return which they're offering, and tenure, let's assume 10 years. So that's typically how the bond will work. Now, this bond, when they are issued in the market, uh, they take into consideration that what is the risk-free rate prevailing in the market. Because let's assume when this company which has issued this bond, at that time, the safest interest rate, let's assume in Indian context, let's assume State Bank of India's FD. So when this bond was issued in the market, SBI FD rate was 8%. Now, you need to give a higher interest rate to attract people to invest towards you. And therefore, they charge a 2% premium, and the coupon was decided at 10% interest. So for next 10 years, if you have 1000 rupees face value bond, every year you will get 100 rupees interest. Let's assume 2 years down the line, if the interest rate rises, what happens? So if the interest rate rises, the SBI FD rates typically will also go up. So SBI FD rate, which was 8%, now let's say it becomes 10%. So now if the same company issues a bond, they cannot issue at 10%. They will issue at obvious, they will issue at higher rate, and the coupon rate of that same company will now be 12%, because you want to maintain a premium of 2%. Now, so the person who has invested in a bond of 10%, he'll feel, oh my God, why have they invested? Because a new bond which issued by the same company is now giving me 12% interest. And therefore, the value of the older bond will fall. So that is intuitively the thing is happening. The same thing applies in the case of interest rate falls. So if the SBI FD rate falls down from 8% to 6%, the company, when they will issue the bond, now they will not issue at 10%, they will issue at 8%. Now in that case, the investor who has already had the bond at 10% coupon rate, but obvious that bond will be a precious bond, because in that he will keep on getting interest at 10%. So the value of that bond will go up. So this is an intuitive explanation why interest rates and bond prices are inversely related, and quite obvious. So if the bond prices fall down and now somebody buys that bond at a cheaper price, his yield will be higher. Why is yield is higher? Because what is yield? Yield investor measures at the price at which he has bought the bond. So because the bond prices have fallen down because of interest rates, these bonds are available at a very cheaper rate. If somebody buys the bond now at this rate, the yield of those bonds to that investor will be higher. So it means the bond prices are highly sensitive to the interest rate prevailing in the economy. So that's the first and very important factor which decides how the prices of the bond changes in the market. Uh, Another very important risk which associates with this bond, and we have discussed uh, a very important thing. For example, before also, that the fund manager invests in the securities. Why in this case our bond? And what do we expect? The bond will keep on paying interest, and at the end of maturity, the principal value will be repaid. Now, what happens if it is a 10-year bond, a 5-year bond, a 20-year bond, and suddenly the company becomes bankrupt? They say, forget about, I cannot pay interest, I cannot pay principal because my business has failed. Now that's a big risk to the company, to the person who is invested in those bonds, because your principal interest is all at the stake, and this risk is basically referred as a credit risk. Now, it is therefore advisable when the bond or issued in the market, because for a small investor it is very difficult to gauge that what kind of credit risk is the company carrying. Therefore, there are independent rating agencies who rate the bond. For example, there are AAA bonds, AA bonds, single A bond, triple B, double B, and these are rated based upon what is the guarantee that the principal and interest will be timely repaid. And it is expected that these rating agencies will act independently and give their rating. So AAA primarily facing means that as per Standard and Poor or Moody's or ICRA or Fitch, that according to them they have done a detailed analysis, and they feel that there's a very low degree of credit risk in this. Now this gives a surety to investor. We find enough, the chances of default in this bond is highly negligible, is very negligible, and therefore there are very less chance of going a credit risk. As you go down the ladder, the credit risk chances are higher. Now, very important need to understand. Uh, One of the important parameter which also goes into play is about risk and return. Fine enough, triple A rated bonds are said to be safe, but the coupon rate which you are getting in these will be much lesser vis-a-vis what you're getting in triple C or double B or triple B. So, and that's the reason why they become a risky bond, because possibly triple A rated bond might be giving a 7% interest, whereas double B rated bond might be giving 12% interest. And because it is 12% interest, the cost of capital for the company is higher, and it is really the company need to work very hard to justify that cost of capital, and therefore the bond becomes a risky bond. But people who are people who are ready to take risk, and they feel that business model is good, the bond will not default, and even at a triple B or double B or single B or even a triple C, the investors can go for the bond because they are getting a higher interest rates. So this is a very important aspect, and will, because in this story the credit risk played a very important role. The third risk which happens in the mutual fund of debt category is, which happened here also, which the Franklin Templeton also cited, that is the liquidity risk. Now, what is the liquidity risk? The mutual fund always under pressure of high redemption. Now, especially an open-ended mutual fund scheme where you are always allowed to have a fresh investment and always a fresh redemption. So mutual fund schemes, the fund manager always have some money in cash. Why do they keep the money in cash? Because there's always some redemptions coming their way, and they use that cash to pay off that redemptions. They also believe that the new fresh investments will also come into picture, so they maintain the cash margin in such a case that redemptions can be taken care of. And in case the redemptions they do not have enough cash, then what option they have? Well, the second option which they have, that they can go and borrow a short-term loan. In India also, the SEBI allows the companies to have 20% of the of your AUM as a loan they can take for short term, just to ease away the high redemption pressure. But as seen in the Franklin Templeton case, when the redemption pressure is very high, it becomes very critical to save the fund. So this is always a catch-22 situation, that how much cash the fund should have to handle the redemption pressure. Because if you keep the entire money in cash, then there's another counter question, that investors have given you money to invest, not to keep in cash. Because if they have to keep the money in cash, why are they lending? Why are they investing on your fund? They could have kept in that in the saving bank account, where they could have got 3.5-4% interest. Now here they are giving you money not to keep it in cash, but to invest and get some returns. So if you keep a lot of money in cash, quite obvious you are compromising on the returns which you could have generated on that money. So there's an opportunity cost which is associated. But under conditions like this, it is always necessary that fund managers to have some cash to handle this redemption pressure. Now, so one always temptation of the fund managers is to have to generate a high returns. Now, as you have seen, if you want to generate a high returns, how can I do this? One of the ways of doing it, you take some adventurous step and go in a lower category risk, in a lower categories of funds. The lower category means you go and invest in like a single A bond, triple B instruments, and avoid taking AAA bonds, because AAA bonds are instruments are not giving you high returns. You start getting high returns when you move down the ladder. You invest in AA, you invest in A, you invest in triple B. It is where there you start getting returns, and you take a risk. You assume, okay, fine enough, the companies the companies are big companies, they will not default, and they are giving you higher better coupon, and therefore let's invest on them and generate high returns. Now, Franklin Templeton was an outlier in this. If you can see here, this indicates that what is the amount of money which the the other categories in other AMCs have invested in these categories. So if you look at this is ultra short duration funds, where in A-rated security, the A-rated instruments, the investment in 2018 by other funds is 1%, and 11% in the 2019. But in whereas Franklin Templeton, The ultra short duration fund was taking exposure in less than A category rating is 22% and 39% in 2019. So the risk taken by the Franklin Templeton was much higher. They were investing aggressively. Aggressively, they were investing in bonds of lower categories. So um, they were taking aggressive calls because they were believing that by taking aggressive calls, they will be able to generate higher returns for the investors. So almost in all categories, if you look at low duration funds, the exposure of overall industry in A rated instruments is 11%, whereas the Franklin Templeton has invested majority of the money in less than in low rated securities. So over a period of time in 2018-19, we can see that Franklin Templeton, most of the funds have been invested across a low rated securities. So it's not only credit risk fund. I can understand that as a credit risk fund, they have a liberty to invest. But even in a ultra short duration fund, low duration fund, which are supposed to be a non-riskier fund, a lesser riskier fund, even in these fund, the exposure in a low rated securities by Franklin Templeton was very high. Now, why was they doing it? So they were doing it because they were chasing the yield. As I mentioned, one of these bonds give you a higher coupon rate, their yield returns are higher, and therefore the returns generated over by these schemes over a period of time, you can see is in 2016, 17, 18, 9% by credit risk fund, near about 10%, 8% by dynamic fund, low duration fund giving 8.5, 8.7 by short duration fund, and ultra short duration fund generated a return of 8%. So by 2018, the story was going very well. And if you see, the Franklin Templeton was giving a very high return. So it is not that they were beating. By 2018, they were actually beating in all their schemes were beating the average category. So Franklin Templeton corporate debt fund was giving return of 7.5% versus average industry 6.1%. Franklin credit risk fund was giving 8.44% versus 5.89 by average returns by other industry average. Dynamic accrual 8.42, again much more than the average of the industry. So there till 2017-18, if you look in 2017-18, their adventurous call was paying. They were generating a higher returns on their funds. By how? By taking exposure, very high exposure in low credit instruments. The story, however, started turning reverse in 2019. What happened in 2019? In 2019, some of the big uh, bankruptcy starts coming up. First of the story was what obvious was ILFS. ILFS crisis broke up in 2018, and Franklin Templeton, even though ILFS it was very peculiar because it was highly rated at AAA, came down to AA and single A. But ILF in Franklin Templeton has a good amount of exposure in this, even at the lower rated securities. When the ILFS was rated lower, even at that time, the Templeton was having a very good exposure in this. Other thing which happened in December 2018, another fund, another bond debt which went out of the market, which went out of the toss was in SL Group companies. Look at the exposure. It's not that Franklin Templeton only has an exposure. Most of the AMCs have exposure in this. So Franklin Templeton, near about 1,000 crore was there in SL Group of companies. Come March 31st, 2019, another thing which broke out is DHFL. DHFL, again, Franklin Templeton carries an exposure of 560 CR. Story doesn't end here. Then it comes, another was Reliance ADG Group. All these companies are fighting in insolvency and bankruptcy court. Again, Franklin Templeton had exposure of 960 crores in this. Then comes the saga of Yes Bank, that ATR bond. Again, in this, Franklin Templeton exposure of 1,000 crore rupees. And to make the matter worse, was Vodafone Idea, where the Franklin has an exposure of near about 2,000 crore rupees. So all these, now these are not small groups; these are big groups. But over a period of time, we have seen how these groups have been shuttered, and because of overexposure of Franklin Templeton on these groups, and because of default happening in these groups, the debt funds were on the backslash, and Franklin Templeton was no exception in that. However, Templeton took a much more aggressive call than many other fund houses. And what happens now? Now, as soon as these sagas went open in the market, but obvious, the investors start withdrawing their money. The redemption starts coming up, and the redemption stories goes up. People start withdrawing the money from the debt fund. Their faith over debt fund goes down, and the same thing happens. So if you look at this, this is what the AUM look of these six funds. So on 2018 August, the corpus, this has the total corpus of these six schemes was near about 47,000 crore rupees. In March 2020, it was 30,000 crore rupees, and by the time the scheme was were closed, this was near about 26,000 crore rupees. Now, which means there was huge redemption pressure coming on Franklin Templeton. Now, what option did they have in this? The option did what they have is they might have used all the cash reserve which they had. So if you look at this, these are the snapshot of all the schemes at the time when these schemes were closed down. So if you can look here, uh, look each scheme at 2,737 crore came down to 2,399 crore, 3,119 crore dynamic accrual fund come down to 2,564 crores, from 4,433 came down to 3,500 crore near about, from 7,000 crore it came down to 57 crore near about, and therefore in almost all schemes in just 22 days there was a huge redemption pressure. Now, what the fund manager could have done? Well, they must have tried all their armory to avoid this. First, look at this. They hardly have any cash left. They are actually borrowing it here. So they already have borrowed. So look at here. There's a minus here. So they already have borrowed money to avoid this redemption pressure. Secondly, what actually look at the other categories. Now, when there's a high degree of redemption pressure, you want to either first of all you use your cash. You already are in the negative. That means you already have borrowed this. What is the second option left? The second option left, you start selling your securities. Now you have major exposure in this lower categories bond. Look at this, these are lower categories bond. Now these are low rated companies. Now when you want to sell these companies, when these sell companies bonds in the market, there is no buyer, because these companies are, most of the companies are bankrupt. Their balance sheets are bleeding, and therefore nobody would like to buy these kinds of bonds, because there is a risk associated with the bond, whether these companies will be able to survive their entire maturity or not. And therefore what you end up doing it, you start selling a good bonds, which is a AAA bond or government bonds, and this further you start selling them. Even it was not a time to sell, but you start selling these bonds. And what happens because of this, your portfolio further becomes skewed towards this low rated securities, and therefore it is a catch 22 situation for the fund manager, and he was have no option but to stop the redemption and the subscription of the fund. So this what has led one can say yes, the COVID-19 crisis, because of the high redemption pressure, there's a liquidity problem across everywhere. Everybody wants to in cash, and therefore people want to have cash with themselves rather than being to their funds. But it is not that the story has built overnight. This was building over a period of time. However, this crisis just accentuated and just brought this to this wall, and where the fund manager possibly has no option but to close the fund. Now, what happens next? Now, what happens to the investor for this fund? Well, uh, as per the notice there in this their website, the fund will continue to publish NAV daily. Uh, they will not charge any investment management fees, so their expense can be reduced. And they believe that as the pressure in the bond market eases, as the COVID-19 crisis eases down, and they possibly there will be liquidity in the market, and they'll be able to sell the bond in the market, or they will hold the bond till maturity, and when they will receive the maturity amount, they will pay their investors. Now, but obvious, the bonds having a lower duration. So if you look at the duration of each category of portfolios given, so bond having a scheme having a lower duration, a bond having a lower duration will be redeemed first. So longer duration bonds carrying a higher more degree of risk, because they will have a longer time for their maturity. And but the one more crisis persists, because they all believe that these bonds, the companies which have issued these bonds will honor their commitment. we are seeing around what how the crisis of COVID-19 is unfolding, and we may see many companies may not be able to pay and honor their commitment, and that will be really a very serious condition for this fund, because at present, uh, possibly these companies who have issued the bond, it is expected that they will keep on paying the interest, and they will honor their maturity amount. But it has to be seen whether all these companies are able to do that continuously, they are able to pay their interest continuously, and they are able to honor their maturity. And if they do not, there's another problem that will come up, and then there will be a long process of winding up of company and going for insolvency, and then getting selling their assets of the company, and that's a very long tedious process. And so that's the reason why this is not a very easy thing to be resolved in just next day. It will take a time for entire things to uncover. And as you can see, the maturity, if you can see, this is how they have all their schemes of Franklin Templeton has been laid down. So there are maturity which will come about near about 4,260 crore beyond 5 years, which is near about 13.81% of their scheme, and which means the entire money is not coming in just a day or two. It will take time before all the bonds will mature, and the company will be able to repay all the investors which have invested in these bonds. Now, the question then comes, what happens to the other debt funds? This is about Franklin Templeton. Though this story is not holding only in Franklin Templeton, this story surely will be going to many other mutual fund schemes. Yes, it is quite correct. Over a period of time, many of the AMCs have gone conservative, they have gone risk averse, and you can see in this chart here, from March 2019 to March 2020, the exposure to AA category and below, which was supposed to be 15%, has come down to 10%. So the companies have shifted most of their debt portfolio either in government securities or in AAA rated bond. So yes, still the entire amount of money is not out of the risk. This is 10% of the AUM of the entire mutual fund industry is still in these AA rated bonds. But over a period of time, most of the AMCs have shifted their portfolio to a more conservative and more safer debt instruments. So, but one need to be cautious. One need to be cautious as and one need to look at the portfolio of your mutual fund scheme. And as you can see in this data which has been compiled by Business Line, that the companies or the scheme which have exposure or into triple double A rated securities. So this is the amount of money which they have invested in double rated securities, and therefore investors must look out and exit from those schemes which have exposure, high exposure to double A rated instruments, because double A or less than that rated instrument, because if the COVID crisis persists, we will see a lot of bleeding happening in debt market. We will see some companies defaulting in their debt obligation, and that will have a very critical bleeding on these funds also. So it is better to be safe and to be there in those funds which have more exposure to government securities and or AAA rated bonds. Another thing one must look out when you are looking at the debt scheme is that how much concentration is there on one instrument, on one security by a fund manager. The larger you invest, and one of the reasons is you invest in mutual fund because one advantage you want to drive is diversification. You want to put don't want to put all your eggs in one basket or concentrate by putting one lot of money in one bond. As you can see in Franklin Low Duration Fund, near about 10.79% of the assets were in GM Financial Asset Reconstruction. This company is in very bad shape. 7.93% in Renew Power, another company which is in bad shape. Income Opportunity Fund was holding 10% money in Pyramid Capital and Housing Finance. So now these companies are again in dire state, which means it's not about investing in a lower category fund or lower category bond instruments, but you are investing a lot of money in one single paper, and that means if that company fails, you are at a very high degree of risk. So one another thing one need to look about is what is the level of diversification. So even if this percentages are lesser, the impact would have been lesser. But putting a lot of money in one paper, and that too in a paper which is of a lower category, does carry a big risk in the portfolio. And therefore one should look, when investing in debt fund, what is the concentration risk, and how much what is the level of diversification in the fund. Well, after this mayhem, the central bank intervened, and they intervened by announcing that they are opening a window of 50,000 crore rupees, which is referred as a special liquidity facility for mutual fund, so that they can have ease out liquidity pressure. Now, what is this actually scheme which they brought about? Well, the RBI is giving money to banks for what purpose? And bank can give this money to mutual fund by extending loan, so that this redemption pressure can be carried out for this. And secondly, banks can also outrightly purchase these investment or corporate bonds or certificate of deposits which are held by mutual fund. And if they will purchase it, then eventually they will be the owner of these instruments, and whenever the maturity of these instruments will come, the banks will collect that interest and maturity amount. And in this way, they will be able to give some liquidity to the mutual fund houses, and these mutual fund houses can then handle the redemption requests which are coming from investors. So this is an attempt, a very prompt attempt, a right attempt which has been taken by RBI, so as to ease the pressure of very high liquidity pressure which a mutual fund sector is going through, especially in bond fund, in the bond market or in debt market. uh, However, there is a bottleneck in this intervention, and the analysts feel that even our banking sector is not out of the mud at present. There is a lot of amalgamation and changes are happening at the top level of management. There is an NPA problem. So banks may still be reluctant whether the bank will lend to the mutual fund, because they again will fear that the default will happen on the mutual fund size. Then why will so if the and then another second question is, you are asking bank to buy those low rated debt securities from mutual fund. Now again, these are poor asset qualities. Whether the bank will buy them, and at what amount they will buy them, again it has to be seen, because if even if the RBI has given window to bank, but it is up to the bank whether they are lending to the mutual fund or whether they will buy those low rated debt securities, because eventually these securities are low rated, and if nobody is ready to buy them, why should a bank buy them? So that's another critical thing, has to be looked upon, whether this scheme will actually work or not. But yes, to some extent, it will provide a breather to a mutual fund industry. Uh, However, we have learned some lesson from this crisis, and one very important thing, especially for financial advisor, for wealth advisors, and for investors who are investing in debt fund. Debt fund has been categorized as fund which do not carry a risk, and you generally say, okay, fine enough. If you are a highly risk averse investor, don't invest in equities because equities are highly volatile, and you move toward a debt fund. Yes, debt funds are less volatile, but they do carry risks, and and if you are getting returns on the debt fund which are high, you do also carry a high degree of risk. So investors have to be very cautious when investing in the debt fund. It is not coming free of cost. It does carry a risk associated with it. Secondly, one very demand which is of industry, which of investors has been, and this is the role of government, a regulator, that you need to increase the penetration of bond market. You need to increase the penetration of debt market. In India, most of the debt market is concentrated on only a government securities bond. There is hardly any market, there is hardly any space where you can sell these low credit bonds. Something like there in equity market, even a small cap companies are sold. Is even a companies some there are buyers. It is a debt in the market, so there is a lot of buyers and sellers. There is a lot of retail participation, and therefore you do get some value, you get some market value. There are buyers who can search those buyers in the secondary modern equity market, but that doesn't apply in bond market. In India, the bond market is still in a very nascent phase. There is no market penetration. There is not a very high participation of many players in the bond market, and therefore, had this been there, most of the liquidity problems could have been eased off if the bonds are traded very freely in the bond market. Thirdly, we also need to look about the risk which are associated in these securities and how these funds to be valued. In most of the cases, the at times the RBI as SEBI has asked to value them on mark to market, but when these kind of crises come, how the valuations of debt fund need to be done. And fourthly, one very important thing which my personal observation was that these funds, the Franklin Templeton, these funds which were there, barring one fund which is a credit risk fund, funds like low duration fund, funds like ultra short bond fund, short term income plan, even these funds have taken a lot of exposure in a very low category bonds, and it's the rule of regulator. That's the role of regulator to see that is what is the quality of uh, papers in which these funds are investing, because primarily investors invest in these funds thinking that there is a very low probability that the principal will fall, that at least there will be no principal erosion. But if these fund managers are very adventurous and investing even in these funds which are not supposed to be there in these low quality debt, just to make some high premium returns, the regulator need to know this, and the regulator need to scrutinize whether these funds, the managers who have invested in these funds, are actually should be allowed. So, as my personal opinion, fund like low duration fund, Franklin low duration fund, should not have invested the money in any invest money in which are rated like for double A or C category. Also, look at the C category, the B plus. Now, this is not desirable because people invest in these kind of fund thinking at least their principal will be safe. And if these kind of things happen, it is really the faith of investors and mutual fund goes down. So this was, I've tried to explain what actually has happened in this Franklin Templeton debt fund crisis. But let me assure this, it does not mean a mutual fund is still a very good source of investment. And however, when you are investing in mutual fund schemes, whether equity or debt, one need to look at the portfolio and keep on continuously looking at the portfolio at the regular level, that how the things are changing. Thank you very much for looking this.